Hey guys, welcome back to the channel. The channel's name is The Covered Caller. My name's Max. Appreciate you guys being here as usual. Have a special guest today, and I'm sure everyone here knows him. We have a Mr. Mike Khouw from YieldMax. What is actually your title at YieldMax, Mike? I'm not even really sure.
So I am the YieldMax strategist. So in that role, I basically do three things. One of them is that I'm the spokesperson for the YieldMax family of products. The other thing I do is I interact with some of the folks on the investment team. So the investment team is going to be the traders, the portfolio managers, the CIO, Mike Khouw, and I'm on the Ulti investment committee, for example. So I get to participate in that process, and just a little bit about the security selection. And I get to lend my experience, my views as an options trader to the rest of the investment team. I don't actually trade the securities that are in there. I don't have the final say on what gets selected for the portfolio, but I'm involved in the process. And independent of that, I like to think that I do some work as an educator in the options world, just in general for YieldMax, but also in general, internal and external. So I talk about all the things that are associated with these strategies and other strategies too. For example, last week I was spending a little bit of time talking with some of the folks on the marketing team about how one does total return calculations. Do you reinvest into the underlying security, things like that?
Mike, that's your forte in life, I think, is explaining difficult concepts and making them understandable. And I know that from watching you on, that's what you do on CNBC, but that's just kind of who you are. And so, yeah, this job could not have, you couldn't fit this job any better, in my opinion, I don't think. Well, yeah, you're welcome. I wanted to ask, we're going to get to YieldMax and stuff in a second, but the guys and I in my Discord were talking the other day. We're always looking for a way to hedge the portfolio using volatility by somehow investing in volatility directly. Maybe the VIX, maybe an ETN like UVXY or UVIX. My question is, should a retail trader be doing that one? And if so, or is there a smart way to do that?
So I guess the first thing I would say is, can or should a retail trader be doing that? And I think that actually depends on the retail trader. Retail traders these days have gotten so much more sophisticated. They have so many more tools available to them, so much more information available to them. And also the platforms they use have gotten so much better. So I don't know what the people within your community are using as their trading and brokerage platform. Personally, for some of my self-directed stuff, I happen to use Interactive Brokers. This is not intended to promote Interactive Brokers versus the TD Ameritrade system and Thinkorswim, which is, I think, also very good. The only reason I happen to use it is because I opened that account over 20 years ago, and they at the time they had tools that not a lot of other systems did. But doing things like seeing what the implied volatility is, seeing your Greeks. So, for example, if you're trying to trade volatility by buying options and then hedging them dynamically, these platforms allow you to do that. A lot of them do, and it's interesting because I went to the Hood Summit last summer, and Robinhood is trying very hard, I think, to become sort of the self-directed investors super app, if you will. Yeah. And as I was looking at the things that they were rolling out, actually the same thing that I was always impressed with Thinkorswim, when I started seeing secondary and tertiary Greeks. So what are the primary Greeks? Those are things like delta, vega, gamma, theta. But when I started seeing like Vanna, Voma, Charm, and stuff like that, I was thinking, wow, I mean, these platforms are really sophisticated. So in some ways, not actually just in some ways, in most ways, retail traders today have more tools than I did when I first started trading options on the floor. Because, back in those days, we used to use this.
Yeah.
a programmable calculator.
Sure.
And the difference between this one, which is an HP 12C Platinum, and the original HP 12, which is what a lot of options traders used, was how many lines of codes you could program into this thing. So the original one, you could not even do American style options that had discrete dividends, because the number of lines you could put into this thing wouldn't accommodate that. So you would just use a basic Black-Scholes.
Sure.
This one takes a few more lines of code. There was a really well-known finance quant, a professor, and he actually, I reached out to him once because he wrote some of the programs that these things use, a guy named Peter Carr. Unfortunately, he died relatively young. But yeah, I mean, we did things with that, and basically, and what we called our sheets. So we would have, basically different volatility assumptions, different price for the underlying, and we would have a matrix, and we could reference approximately what we thought an option was worth like that, and we could also reference our approximate Greeks. So the retail trader has many more tools available to them. So the answer is, can they? Sure. The tools are absolutely there. People can feed APIs into their Excel, and you can do all kinds of sophisticated stuff this way. So the answer is sure, they can. Really, how you do that is going to be a function of what your objectives are. So you referenced hedging, I think, as part of the reason why people are interested, right? So, there are exchange traded products that focus on volatility. Exchange traded notes, for example. And of course, you could trade VIX futures. You can trade options on VIX futures. The one thing I really would caution people, though, in that realm is that in many cases, you're dealing with derivatives of derivatives, or derivatives of derivatives of derivatives. So as you get further and further down the chain, having an intuition for how that is going to behave in times of market stress gets a little bit harder over the course of time. Because when people look at the VIX, so what is the VIX? The VIX is simply, it's a measurement of implied volatility in the S&P 500 index. Spot VIX, the VIX index, is always looking 30 days out at a strip of options in the S&P, and then it weights that strip to come up with one number. And if there are no options that expire exactly 30 days, then it takes the nearest options, that expire right before and immediately following, and it interpolates the value of the options. The options that are used in the strip are essentially all the puts for which there is a bid greater than zero, and all the calls for which there is a bid greater than zero. Now, this has an interesting characteristic when people think about it for two reasons. One, spot VIX itself is not a tradable instrument. So the instruments that you can trade don't always behave exactly the same way as the one that you observe.
Yeah.
And this should make the way this makes sense to people is that because the VIX is always looking 30 days in advance, it's essentially like a 30-day forecast. So I cannot buy today's weather forecast and sell tomorrow's weather forecast, right? That wouldn't make any sense. Or buy today's weather forecast, expecting, for example, that the temperature 30 days from now is going to be substantially higher, and then sell the forecast on July 4th, because they're looking at very different things. So July 4th forecast is the forecast on July 4th. Today's is today's. So when you're dealing with these instruments, that's an important consideration. The futures are these sort of discrete windows through time.
Yeah.
And where people get caught out frequently is that they say, oh, I think the VIX might spike. Okay, fair enough. So they buy some future, and then the VIX does spike, but their future does relatively little. And the reason they're struggling to understand, they're like, well, wait a minute, the VIX just went way up. How come my longer term VIX future isn't making any money? And the reason is because your VIX future is the forecast for some period in the future. Vol may very well come in by then. So what you find is that when you look at the VIX futures curve, spot VIX is most volatile generally, and then the next future is going to be slightly less and slightly less. And as you go further out in time, they don't necessarily behave the way I think a lot of people think that they will. And I've seen people get caught out by that.
Yeah, me too. Me too. I always just buy a call spread in either the VIX or UVXY or something, and it never works out. I mean, I'm trying to be smart, buying an at the money call to finance the out of the money call. But it's maybe worked out once or twice, but it's just so hard to hit those trades. But I suspected you were going to say what you did. But thanks for clearing that up. Let's talk real quick before we get into YieldMax stuff. Let's talk about one other thing. So let's talk about your macro forecast. Now, I know you have an acronym on CNBC every year, and I've heard what it is, but I haven't heard your description. Would you have maybe a 5-minute explanation of your acronym and your macro view on this year?
Yeah, sure. I mean, I think, I'll try to avoid making stock-specific recommendations in this context, but I will say I'll say the following, which is with respect to just what my view was for this year going into it. And that was that, it's not my attitude that you should necessarily peel off trades that are winning. So, for example, last year, one of the names I happened to have liked a lot was Alphabet. Alphabet did exceptionally well. Year before that, Anglo Gold Ashanti was a name that I really liked a lot, which is one of the gold miners. It did very well again last year. But one of the things I do try to think about a little is, where do you deploy new capital to the market? So if you're a working individual and you're deploying a little bit of, to equities each paycheck, where do you put that money? And I just felt at the beginning of this year that to chase, the AI trade, if we'll call it that, it was getting a bit long in the tooth, and the valuations were getting rather heady, we'll call them this. Now, here's the thing. When I say that valuations are high, what I don't mean is that they were expensive on some valuation metric. What would be a valuation metric that I apply to stocks? What's the company's forward free cash flow yield? What is its price to earnings? What is its price to earnings to growth ratio? How does it compare to some of the other stocks in their space? Because in fact, if you looked at a lot of the trades that had done exceptionally well, which would include things like NVIDIA, that would include the aforementioned gold miners, on these metrics, they were not particularly expensive. What I meant by that they'd come very far was that in the case of NVIDIA, you're looking at a business that was worth $4.5 trillion. And eventually, the laws of large numbers have to intrude. If it continued to grow over the course of the next 10 years as fast as it has over the last 10, sooner or later, NVIDIA would be the entirety of the economy. That's just the math of it. So something that cannot go on forever won't. And that growth rate cannot be sustained. And there are a lot of other areas of the economy that I thought just haven't gotten a lot of love lately. So, one of the names I did happen to mention was Fluor Corporation. Fluor Corporation is, for those that don't know, it's an engineering, procurement, construction company.
Yep.
As it happened, Fluor also owned, and still does, they're actually in the process of trying to monetize this investment, a significant piece of SMR. That's the ticker. Company's name is NuScale. SMR stands for a small modular reactor. It's basically a pre-revenue startup that's looking at building small reactors, and it was trading at a very reasonable valuation. So what I was seeing was that there were kind of older economy stocks that were trading at 15, 16 times earnings, and if you believe in the AI trade, and you believe, as some people who say some pretty wild things about it, like Elon Musk, for example, frequently says that the productivity boom that could accompany AI and robotics is so profound that it actually could be sufficient that we could grow our way out of our national debt, for example, or at least we could mitigate some of those problems. Well, if you believe that, then you must also believe that the economy is indeed going to grow. And if the economy is going to grow, then it would stand to reason that some of these other businesses would also do well. So I had a little consumer discretionary in there. I had sort of old economy, construction, and engineering in there. And I had energy in there. And as it happens, so far this year, those trades have actually worked out very nicely. Those sectors have indeed outperformed technology since I first put that trade together, which would have been about the first week of December. Although I don't think it got mentioned on CNBC. I don't remember when it came up on CNBC, but we usually start looking at our trades for the coming year in December, of course, and you're typically going to do that right before Christmas. In fact, I had actually come up with what I called my Christmas shopping list of stocks, and it was a much longer list than we need to get into here. But in many cases, it was sort of older economy stuff, because my thinking was that if the faster growing parts of the economy indeed created a productivity boom, that the other parts of the economy were going to benefit as well.
But that trade has been doing well since December, or even since January. Hopefully you're going to win it this year. Did you win last year or 2 years ago?
2 years ago. 2 years ago, I won. So there's been a couple different measures of analyst performance on CNBC. There was somebody who used to, I don't even know how he did this, but he used to keep track of every analyst or market pundit's trade ideas on every single show. And I saw this website. He had a website where he tracked all of this stuff. And, I saw on there one thing that I didn't happen to agree with, but I thought, who's doing this work? Because it would require being parked in front of a CNBC screen 12 hours a day. So I actually reached out to the guy who was doing it. And at the time, look, outperformance comes and goes. I happen to be the one that was doing the best at that time for the history that he'd been tracking. This was independent of the acronyms. But I reached out to him and said, look, I'm following what you're doing with great interest. How do you do it? So it turned out he'd been a lifelong employee of the Federal Reserve and was retired. And what he did was, sat at home and watched CNBC most of the time and kept track of all of this stuff. So, it's interesting because you often will hear people talk about Jim Cramer's performance, for example.
Sure.
And a lot of people are a lot of big fans of his, and there are people that are not as enamored. One of the things that ends up happening, and I think it's important for everyone to remember, is that he will talk about a lot of stocks. I will talk about a lot about different stocks that are presented to us. They're not a recommendation. They're not a holding, but somebody says, hey, Mike, hey, Jim, hey, Guy Adami, hey, hi, Dan Nathan, what do you think about a following stock? And they're just lending their current thoughts. They're not saying to buy it or to sell it. They may not hold it in their own portfolio, and often they don't. I just will say this in defense of Jim Cramer, who I'm acquainted with. We're not close friends, but he's a very smart guy. Is that his performance on the things that he actually has invested in is different than what a lot of people track, because he's just asked about stocks all day long. And the performance that I think he has on the stocks that he has actually picked for his portfolio tends to outperform what people think of as the Jim Cramer performance. So it's just an observation. If you get asked about stocks, you can say something off the cuff. Isn't a recommendation to buy or sell, but just things to think about.
No, absolutely. And I didn't think that I forgot. I should have watched CNBC. You're rising, so the letters in rising stand for symbols, don't they? And I know you can't, or do they stand for themes?
So the rules have changed a little bit for this year. The way it's supposed to work, but it hasn't in every person's case. And actually, so I will point out that in my BRAVE acronym, the A stood for AU, which was a thematic trade because it's the elemental symbol for gold, but it's also a ticker. AU is the symbol for Anglo Gold Ashanti.
Oh, that's true.
So it's both. The rules of the game are that they are supposed to, they don't always, but they are supposed to be the first letter of a ticker symbol.
Okay.
The other thing is that they are, in general, not supposed to be an ETF. Now, I have used ETFs. So, for example, I used I for IBIT, which is an ETF that tracks Bitcoin. And I used N for Nance, NANC, which is the ETF. It's actually an ETF on the Tidal Financial Group platform that tracks the Democratic members of Congress and their trading activities, which have tended to outperform the market overall, believe it or not, and have actually also outperformed the Republicans. So I did throw that in there. Now that wouldn't be permitted, though. So the modern rules are it's supposed to be a stock unless you get an exception. They introduced something else that I think is kind of interesting, which is that I believe this year, 4 times a year, maybe at the end of every quarter, or maybe it's twice, you actually get to pull one of your symbols out and stick another one in.
Oh, that's great.
Yeah, and the reason this is important is because your viewers may know who Steve Grasso is. Steve Grasso's nickname on Fast Money is the Governor. He has that name, by the way, because he was on the floor of the New York Stock Exchange, and he was a floor governor down there. So you have, sort of people who are supposed to resolve and differences that come up, and governor's kind of as high up as you get on the floor in terms of resolving something that comes up in the middle of the trading day and other things. So last year, U.S. Steel was in his acronym.
Okay.
And partway through the year, this company was acquired. So that was a win, of course, but that meant that capital was effectively undeployed for the balance of the year. And arguably, he should have been able to say, hey, wait a minute, we bought the stock. The stock was acquired, so it has now been converted to cash. We have no choice about that. So how do we redeploy it? But I will also say that last year was quite remarkable because I was taking a look at the performance of a lot of the people on the network, and many outperformed the S&P, and they outperformed it handily. Guy Adami outperformed the S&P by a lot. So did Karen Feinerman. I believe Dan Nathan did as well. And for my own acronym, I had given them a long one for last year, very long. Yeah. And it got dinged. It was Bond Vigilantes was the name. Was my acronym. And they said, absolutely not. You can't do that. So then I had one that was rising, but it had 2 G's because I wanted to keep gold in the trade. But I also wanted to add Alphabet. So I had the G for Google. And so on my YouTube channel, I mentioned rising with 2 G's, but on the air, they said, no, you can only have 6. So I think it's a fun game. I like the idea that people present their best ideas. Once you start sort of cornering them so it has to be a cutesy acronym as well, chances are they're going to end up including something that they probably wouldn't if they, were going to do, what they would actually trade with real money. And by the way, this is trade with real money and then leave it. No ability to modify it until December 31st. So this rule change, I think, is also a good one. But I had come up with my acronym before I knew about the rule change. I gave it to them, and then they said, oh, by the way, once a quarter or, so I'll find out. They'll probably reach out to me at some point and say, hey, do you want to change anything in your acronym? But it's a worthwhile exercise.
Heck yeah. No, I look forward to that every year. Although I say that, I didn't see this year's, but I'll remember Brave and I'll remember the past years. All right. Well, let's talk about YieldMax a little. So first of all, I saw a prospectus today. I guess you probably can't talk about that. But anyway, you're coming, just for the people watching, they're coming out with something, or they filed a prospectus. We'll see if you get approved. But for a fund that uses the top 10 performing out of the YieldMax universe, and it can even include inverses from what I read in the prospectus. And anyway, I just saw that for the first time this morning. I was real happy about that. I'm going to tell you why. I'll ask you a question that you can comment on. So I'm hoping that this thing is going to replace FEAT, F-E-A-T. I don't like that fund. I think that's a bad fund. I think it's a failed strategy, or it's just not for me. I bought it the day it came out. When I read the prospectus, I loved the idea of it and stuff, but I just think the execution has been lacking. So I think that this will be a better idea for several reasons. One, because it's made up of 10 funds instead of 5. But would you like to comment on features performance, FEAT and 5E's performance? I mean, I just don't care for those funds.
So, what's interesting about FEAT and 5E, for those who don't know, those are Dorsey Wright funds. So if folks don't know what Dorsey Wright is it's not a business that's affiliated with YieldMax or with Title. It's actually a registered investment advisor that's owned by the NASDAQ, by the exchange, the NASDAQ. one of the things that Dorsey Wright was known for were some proprietary technical analysis techniques that would identify when to buy and sell securities. And in its own way, I think it was kind of a novel and interesting idea. Can an external investment approach, technical investment approach, be deployed to look at the universe of YieldMax ETFs and then allocate to them, basically on somebody else's technical rule set?
Yeah.
And that, the issue that I have with this, there's a couple things. But then, of course, you essentially sacrifice the investment decision-making process to somebody else.
Sure.
And in this case, it's Dorsey Wright. I'm not here to criticize Dorsey Wright's approach. A lot of people really like it and have had great, success with it. However, when you start dealing with technical analysis and then you start dealing with funds that have slightly different investment characteristics, so funds that are intended to make big distributions of gains and of options premium may end up having a different sort of price behavior than the approach that they actually developed that technical analysis signaling tool to apply to. So, I guess I think that it's probably better that either investors take their own investment approach, which is based perhaps on how they feel about the underlying securities. That's really important. You don't buy NVIDIA if you don't like NVIDIA. You don't buy Tesla if you don't like Tesla. And if you happen to feel that either of those are going to go in the opposite direction, then you can tactically switch from, say Tesla to CRSH. You can go the other way if you choose. And I think you might be sacrificing a bit too much of that sometimes in some of these strategies. On the other hand, these things have not been around that long. Is it possible that the technical analysis tools that Dorsey Wright employs will actually become effective over longer course of time?
Possibly.
They might. I mean, I just don't know. Truth be told, I don't know enough about Dorsey Wright's approach because some elements of it are proprietary for good reason. Why would they give up every last bit of their secret sauce? But I suspect that, for most investors, you're probably just trying to pick the underpinnings YieldMax ETFs that best represent your view for the underlying assets and your like for the strategy. And when you start blending in somebody else's technical approach, that might not be for everybody.
Yeah. I think Feed only has 10, 11, 12 million under management. And it's never been above zero. Not its NAV. Its total return has never been above zero. Yeah,
just under 11 by the looks of it right now in feet.
Yeah. If you want to bring up your Bloomberg machine, I can put it on the screen. There we go.
Yeah, there we go. So, just so everybody who's looking at this, the dividend adjusted value is here in orange. It does look like perhaps so this was its sort of high moment. That was on October 9th. So let's see.
Well, I don't have a Bloomberg machine, but on my
and why would you? So it looks like it had positive. It was actually up at that point. That was 4.2% annualized is how it was as of the first week of October. And a lot of these products, people might also say, well, if you want to use them tactically, one of the advantages of an ETF versus something like a mutual fund is that it trades like a stock. So there are, people can deploy them tactically as they see fit. I mean, in the off chance that somebody had said, oh, well, I think the damage done on post-Liberation Day was too great, and they were going to, say, okay, well, I'm going to get long this thing at that point. Obviously, the returns were very good there, but I mean, so were the returns for the S&P. See what the S&P did over that same period of time.
Well, I got long LFGY after graduation or after Liberation Day, and I did great. I sold it in October also. I run it all the way up and sold all of it, and I did wonderful. I bet I did a lot better than Feet did, but I mean,
Yeah, so let's take a look. I mean, over that period of time, the S&P had total returns of about 35.9%. And over that time frame, FEAT had 38% if you just took the distributions in cash, 41.5% if you reinvested in the security. And you did LFGY as a tactical trade at that time. And if you bottom ticked and top ticked, I don't know who does that. I don't. Yeah, so those returns are obviously exceptional. That's 63.5% and 71.3.
And I also got Alti, and I already had Alti, but after the damage was too bad on Liberation Day, I doubled down, and I had like 25% in Alti going in the summer and rode it all the way up, and then I sold some in September, sold some in October, and been riding the rest of it down. But I agree, FEAT to be a tactic, but it still to me just looks. Here's my theory. I mean, on technical analysis, your time frame is everything that you're looking at. I'm sure they're doing great. Maybe they have a longer term time frame that's designed to catch longer term trends. And maybe I'm too impatient. Like you say, maybe it will start working at some point in the future.
I mean, my thinking is that in terms of longer term trends, there are a lot on the single stock covered call ETFs, because you need to have a view that's for the long side ones, bullish on the underlying asset. That is a circumstance that can change, very quickly. So I, again, because I don't know enough about their technical approach, I can't really speak to it. I think that the Dorsey Wright funds are for those that like their technical approach and wanted them applied to the securities that a YieldMax has. But for my own purposes, I've never traded either one of those because I feel like I'm relinquishing the decision-making process to an outside agency, and that's not something I'm typically comfortable with. I like to be the guy in the driver's seat, not the passenger.
Sure. So, are you? Well, let me. So, can you answer this question about Y10? I mean, are you guys going to sub-advise that one? Is that one internal? And that one's going to be in-house, right? The one that's proposed.
Yeah. So I actually, I'm not 100% sure what I haven't read the investment process statement for that one, so I don't know exactly how that works. I mean, I can speak to, Alti, for example. Let's just talk about Alti since I happen to have it on the screen and you were just mentioning it. So the process for the securities in there, that's a process that I'm pretty familiar with, because it really is based on a couple things. It's based on, there are some technical components, there are some fundamental components, there is a separate sort of sleeve of the portfolio that's intended to be not anti-correlated, but non-correlated. And the first two are part of a screen that's basically run continuously. So, and this goes to what could be essentially added to the portfolio, right? So once something's in the portfolio, the calculus changes a little bit, and then you have higher conviction securities and you have lower conviction securities. And eventually, you might have something that's not in the portfolio at a moment in time, but your conviction on that is rising as a function of the factors that go into security selection. And some of the ones that are in there may fall off, or maybe some of the anticipated move has taken place. So names get pulled out of the security, new ones get added. With respect to the new funds, I haven't reviewed all of that completely. So essentially, you file, and then you might have to make some modifications depending on how the filing is reviewed. Once that is done, then we can essentially begin to codify the rest of that process. And once we do that, then I get sort of more visibility on it. But at this point, I can't really speak to it because I don't know.
Well, so you were saying that you hadn't traded FEAT, and so that brings me to another question. I mean, you did buy some shares in MSTY, or you tried to at one point.
I did. Right? Oh, I did. I actually bought. In fact, the day that I bought some MSTY, I think even before I joined YieldMax and didn't even know I was going to, I had bought some, and I mentioned it on air. So this must go back to, when did I first mention it? It could have been as last May of 2025. I think it would have been. Now, once I started to talk to some of the investment team here, I ended up taking my positions off, including my position in Misty at that point. That was mostly because I thought there might be some sort of regulatory considerations, because I was still having conversations with them about joining. Plus, I was on the air. It was fine for me to be on the air on CNBC and say, here's what I'm buying for my own account, and to go ahead and do that. Once I became involved with the firm, that changed. A couple of reasons. One of them is that if I say, oh, I'm buying Misty for my own account, and I'm actually working for the firm whose security it is, that could be taken as a recommendation to, or a solicitation to buy the security. Obviously, it's not a solicitation if I have no involvement, but all of a sudden, I get a little bit more hamstrung, essentially, from a compliance perspective, once you're involved with a firm versus just being, some talking head on television just saying I'm buying this security and selling that one. So I ended up taking that position off. Now, one of my own rule sets for securities in general is that I don't like to buy anything that is trading below a long-term moving average. And my reason for this is, there's an old saying about it, nothing good happens below long-term moving averages. But the truth of the matter is that, and as I previously mentioned, I've never top tick to sale. I've never bottom tick to purchase. I would much rather have the market tell me that the mood has changed and be late to buying and late to selling than to try and, what we call catch the falling knife. So it got cheaper. And in the case of Misty, so, it started to roll over, traded below its long-term moving averages. And then there was the whole issue of strategy. And it was pretty clear to me that the premium that strategy had been historically enjoying relative to the value of their underlying Bitcoin holdings was dropping. And, now, though, and again, how do I say this without just making sure this, again, not a recommendation, take it for what it's worth, but I'll make the following observation. And that is that how much the Bitcoin that strategy holds is worth, because they tell you how much of it they have. It's just arithmetic. If they have 651,000 Bitcoin and Bitcoin is $60,000 a Bitcoin, multiply one by the other, that's the value of their Bitcoin holdings. Now, you could also just say, well, I'm going to dismiss the rest of their business because relative to the scale of their Bitcoin holdings, the company's operating income is, whether it's a gain or a loss, is de minimis, which is also fair. So then the only other exercise is to dissect the cap structure. So in the case of MicroStrategy, they have a number of bonds, convertible bonds, and they also have these preferred shares, right? So effectively, those are the things that people need to focus their attention on. I might as well just pull this up so people can just
absolutely. Let me put that back on the screen. I saw you on your podcast. You did a great explanation of all the convertibles one day. That was a masterclass. It was 3 or 4 months ago, but
yeah. So I'm not gonna. I mean, it's too long to get through all of them, but this is the important thing for people to remember. So there are 6 convertible bonds. These top 2, which are the ones that are going to be maturing soonest, are 0 coupon bonds. What that means is that the company is not making any payments on those bonds. Essentially, at maturity, they're due back, and they are convertible into the underlying stock. Now, a lot of people will say, when we think about strategy, the stock, that I'm just going to do a quick. So we're going to tab back and forth so people can sort of give this some thought. And I don't know how, I'm going to blow this up a little bit if I can, so that people can see this a little bit more clearly. Oop, yeah. Okay. So just so we know what we're looking at, most people think about a company's value as its market capitalization. What's the market capitalization? It's basically the shares times the price.
Yeah.
Of course, the value of a business is not necessarily just that, because any more than the value of a house is however much equity the owner has in it, right? So the value of the house is the value of the house. Once you extract the value of its contents. Once you extract the mortgage that the owner has on it, it's just the underlying value. When we think about a business, the best proxy for that is actually the enterprise value. So the enterprise value is going to encapsulate not only the market capitalization, but also the net debt or net cash. Net cash would, if the company had net cash, the enterprise value would be lower than the market capitalization. The way to think about this, using my house analogy, if a house is worth $1 million and it has $100,000 in the basement, and you got all of the contents, you would be happy to pay 1.1 million. But X cash, it's only worth $1 million, right? You don't get to include the cash in the value.
Yeah.
So on the other hand, the debt also encapsulates it. So again, using the same example, I have $1 million house. Guy has $200,000 in equity and $800,000 in debt. The value of the house is $1 million. It's the equity plus the debt, right?
Yeah.
The net debt. So that's essentially what this is. And at a simple level, you would say, oh, okay, well, that's $57 billion. And actually, maybe you can just tell me, you happen to know. I'll just check the most recent price for Bitcoin. We'll take a look here.
I have a look this morning.
It is
70, I think.
Yeah, 68,000. Okay. Right. So you could say, all right, well, 68,000 in round numbers times 651,000 Bitcoin, that is 44.27 billion bucks. So you would look at this and say, well, that's less than this $57 billion enterprise value. And you'd say that the company's trading at a premium, but not so fast. Why not? Because as we go over here and we look at this convertible, so this is the first one that's going to be maturing in December of 2009, and we get some details about this convertible bond, and this is the thing I would encourage people to take a look at. Notice the conversion price, $672 per share. The underpinning stock is obviously trading at a huge discount to this. So what that means is that the dilutive effects of that bond for shareholders is, well, it's effectively non-existent, right? Because the stock can go up many, many times before that convert actually has any value, that the embedded call option in the convertible bond. People will refer to these, when you have a convertible bond that's this far out of the money, they will sometimes refer to them as a busted convert. This is effectively a busted convert. And actually, if you are a buyer of strategy shares, you should actually hope that it recovers, because if it recovers, that means that the stock has gone up fivefold, right? That's what it would need to do for this. And now all of these converts. So I like I said, I'm not going to go through each one of them, but there are several of these securities, and they all have different maturity dates. A couple of them do have coupons, but they're really very, very low. So that the highest coupon on any of the converts is these June 2032s that are 2.25. But if you go through all of that and just put it into an Excel sheet, you're going to see essentially what the dilutive effects of that are. And you're going to realize that appreciation in Bitcoin will accrete first to the shareholders of strategy. So, as I look at it, it is more interesting to me, once again, just as I price out the value of strategy relative to the Bitcoin that they hold. It's hard, though, I will say, as I look at Bitcoin, for me not to feel like, wow, there's some folks that are really shooting against this thing. So I'm going to just quickly pull up a 5-year chart here.
Heck yeah.
And in that, now there's a lot of lines and stuff on this. So let me just clean up these lines a little bit. I'm going to include a 200-week moving average.
All right.
For Bitcoin. And I'm also just going to get rid of these grid lines, because I think the grid lines make it actually a little bit too noisy. So let's just get rid of that. And this is just a very interesting level as I look at it, right? So this 58.8, where we just bounced, I think is pretty interesting, because that's essentially where we were a couple of years ago. That's the 200-week moving average. That was this 5-year Fibonacci retracement level, if you happen to care about such things.
I do.
And the important thing for me is, when it comes to technical indicators, what are most people talking about? What are they looking at? it doesn't really matter how you draw the lines, just as long as there are a lot of other people that are drawing them and getting to a critical, getting to a level the same way. So in other words, what I'm saying is you could know nothing about Fibonacci retracements, and you could say, well, actually, look, it got back to this, the Bitcoin was sort of lingering around here for some period of time. So that could be interesting. I could ask my teenage sons, draw me lines on this, where you think that the thing could possibly stop or where it could go. You can see why they might pick this as a level. This is the level, and where it is right now, interestingly enough, is the level from whence it broke out when it got to these new highs. So this is also still a critical level that we're living in right here. Is it going to actually rebound and go this, you can choose your own adventure, or is it actually going to fall back to this level here? I'm going to let other people make that determination. But I will say that to me, I thought this was something to shoot against, this 57.8 level. And it looks like it sort of found some support there. And it's caught a bid above that for more than a couple of days. So we might actually begin to see some stabilization. And if one is so inclined, I don't think strategy is a bad way to play for a bounce here. I don't know that Misty would necessarily be a bad way to play it either. And one other quick point, because we had something else going on here, which is, I'm going to get rid of the price chart. I want us to just take a look at, this is the implied 1 month implied volatility for Misty. Okay. And one of the things you're going to observe is that pretty steadily we were seeing that short dated options premium coming into this period of July had been declining, right? So not only did you have the underlying stock going down, but the amount of premium that one could harvest from selling options on it was at the lowest point it had reached in any of the last 2 years. And notice what's going on now. It has actually started to go back up again. And so what that means is that, because if you buy any kind of a covered call or covered call spread strategy, these are covered call spreads, you need to both like the underlying asset, and in the case of strategy, you kind of have to sort of say, well, how do I feel about Bitcoin? If I like it, do I like MicroStrategy? If I like it, do I like selling premium against strategy and being long the underlying asset? Maybe not so much when vol was below 50.
Yeah.
But look where we are now. I mean, it's at 80.
Yeah.
I mean, implied volatility, the premium on options on strategy stock have almost doubled since July 16th. And, I realize that because you have these huge numbers in here, that the scale is not that clear, but but you can see maybe you can, I'll just tell you, we're at like 83 right now, and it was 44. So it's almost doubled.
No, absolutely. Absolutely. We talk about that all the time. It's interesting that occasionally a stock's price can go up at the same time its IB goes up, and you can also, and that's like the best situation. Then, of course, you don't want them to go down at the same time. I'm noticing that we're out of time. Do you have a few more minutes? We started just a little bit late.
Well, it's President's Day. I'm actually, the markets are closed. So I have, I was going to mention an area where you have this dynamic, where you sometimes see positive price volatility correlation is in commodities. So oftentimes the volatility of a commodity will rise as its price rises. And you will see that sometimes even in the stocks that are associated with those commodities. So if you look, we're going to look at two pictures. We're going to look at what we call the smile, the volatility smile in GDX. And then we're going to look at the same picture effectively in SPY. And we're going to see a little bit of a difference. So you can see GDX, that's the line in white right here, which I'll highlight. Notice how flat this is, and notice how the upside calls are trading, at a good premium to, call it the at the money volatility. On the other hand, you're going to see that in SPY, which is a proxy for the S&P, it's much more downward sloping. And actually, if I shorten this up to say, look out, just call it 1 month, which I'll do now. you're going to actually, this is kind of interesting. That's actually fairly, I guess that's more of an upside bid than I would have even expected in some of these higher strikes for SPY. Although 20% is pretty far out of the money for a 1 month option in SPY. Let's be honest, the S&P doesn't move up 20% in 30 days that often. That would be fairly pronounced. But actually, I would say that's actually a more bullish surface than I might have even expected for the S&P. But you can certainly see it in a commodity-based ETF. These are stocks. Generally speaking, you get more of what we call a smirk than a smile, but you can sort of see that there's sort of an interesting dynamic taking shape. Actually, this is also kind of interesting. So if we look at this, I'm going to put in GDX from, let's go back a month. Or go to the end. Let's look at December 31st from last year. See what it looked like then. So you can see how the sentiment has shifted. Notice that gold was flat to upward sloping then.
Yep.
And you can see that it's kind of flat to downward sloping now. And I think that is also kind of interesting in terms of how it reflects sentiment, because we had that sort of blow off top in the metals. Not last week, but a couple of weeks ago. And we had actually, for what it's worth, we had actually reduced, we have exposure to SILJ, junior silver miners. We have exposure to gold miners and to gold itself. We reduced both of those. People can go back and see our trading records, but the Thursday right before that Friday when things just melted down and we saw a 30% down move in silver, we'd actually reduced our positions that day. And I think it's important for people to understand that, there are times to adjust your positions. And one of the times that you might want to think about adjusting your positions is when your concentration gets too big. These have been big winners. And, what ends up happening is that you can have constituents of your portfolio that just get a little bit outsized. And sometimes when you're looking at technical blow-offs tops, you really want to pay attention. I used to say that the most bearish signal that I could possibly see when I was a commodities trader was when you opened at new highs, traded to a new all-time high, and then closed sharply lower. That kind of a downside intraday reversal was the thing that always scared me the most. And we had a couple close calls before metals actually rolled over. Take a look at what happened intraday, and you'll see we would trade to new all-time highs, and then towards the end of the day, you'd start to see it weaken. And, you're literally biting your nails thinking, is this thing actually going to trade lower today? We hit a new all-time high, but could this thing actually trade lower? It held in there for a few days until it didn't.
I hear you.
Hover over the sell button, folks, when you see those kinds of patterns. It doesn't really matter what the asset is, but it tells you that what it tells you is that I had a friend in college who used to say that he had an expression, as nervous as a long-tailed cat in a room full of rocking chairs.
Yep.
That sort of price action is sort of indicative of that people are basically, they're covering the brakes. And if you see everybody else covering the brakes, you should probably do the same.
No, good advice. Good advice. All right. Well, also as far as YieldMax goes, and I'm going to listen to your answer. I'm going to get up and let the dog out, just out of this office. But anyway, there was a little bit of a controversy a few months ago about this eat your own cooking, and that some of the fund managers maybe didn't own shares or whatever. What did you guys ever resolve that? I mean, I heard you give a few answers to that, and then I have a follow-up question.
Sure. So it's interesting because with respect to updating the disclosures and updating the prospectuses, my understanding, speaking with a couple people inside who are dealing with the legal and the compliance team, is that a lot of that information is now subject, because we're coming to the end of the fiscal year, to be updated. Right. However, I actually was given access to, and I might even be able to share, actually.
All right. That'd be great.
Let me see. So first things first, Mike Venuto, who is the CIO, he publishes his holdings in real time every day. So people can see that it's on Blossom. And
Sure.
he holds the funds.
Yeah.
In the case of Jay Pestrochelli, because he said, I don't understand why it's showing up like that. But in Jay Pestrochelli's case, partially because of his, before he used to be involved with a company called Zega. He still is involved with Zega, but the holdings were not necessarily in his name. But what he did do was he sent me, let me see if I can find this.
Yeah, that's fine.
I didn't know we were going to be talking about this, but he actually makes a point of holding all of the funds. Now, I apologize if there's some things that are blacked out, but the names of these accounts involve people that are not just Jay, like for his example, his wife and stuff like that.
His family. I figured that's what it was. I figured that, I have money, for instance, if somebody tried to sue me or you guys tried to look at it, you're never going to find it. It's buried in a trust. And
let me see. Okay. I'm just scrolling over this. Oh, okay. Yeah. All right. I'm pulling some stuff over onto this screen. Can I do this? Oops.
Oh,
hang on. Hang on. I just need to open this up. I'm going to open as a PDF. All right. I am going to, and there are some other, okay. So I apologize because you're going to see some stuff that's blacked out here.
Sure.
You are going to, now you'll see, so for example, the names of other parties that might be in control of these accounts is not completely, those have been blacked out. So other information. So you see a lot of, what this looks like? It's like when the government says, oh, we're going to release all of this sexy stuff. And then you get it and it's nothing but blacked out. Yeah. Obviously, there would be reasons why people would not want to. I would like to find anybody who says, oh, I'm just going to show you all of my financial statements. But he sent me this. And you can see this is just actually for the period ended at the end of December, right? He owns, his account statement is 42 pages long.
Yeah.
And he is not showing all of the things he has there. But you will notice that, for example, he does own FIA. So you can see he owns, we were talking about the Dorsey Wright funds.
Yeah.
Right? And this is not his only account, but I wanted to just make the point that he owns all of them. Yeah. Not some, all of them. And many other things besides. And that's, luckily he blocked it. So I'm sort of being very careful as I scroll around, but I'm going to take that off because I don't know whether there's information in there that he wouldn't want. But he did give me that, and he did give me permission to share it. He's the one that blacked out some of that stuff. So, but, it came up because Mike's is on Blossom. Jay, for whatever reason, either it's not being picked up as a part of the regular filings, maybe due to account names or trusts or other things. But these guys are all invested. Yeah. And I will also say that other participants are also invested in these funds. So the way the filings work, it is not just an issue of whether. So when they say, the fund manager owns, you will notice that the fund manager's name isn't necessarily the only people that are involved, because there are a lot of traders involved. Scott Snyder, who's sort of the senior trader. Jay is the head of trading, but Scott is sort of the operational head of trading from one day to the next. He's sort of the one that's in the trenches on the trading side every day, actually executing trades, whereas Jay sort of sits at the next layer up, and then Mike is one layer up on the investment committee side, if you will. So they are partners, Mike Venuto and Jay. But there's a lot of people who are involved with the investment process in these funds, and we have a lot of funds. And because of that, when you look at the filing, I'm not exactly sure how that information gets scraped. It gets picked up I believe, from the filings, and the filings are going to depend on whoever was the named portfolio manager, I believe, on the most recent one. So let's just take a look at Alti. I'm curious to see who is thus named as far as the organizational responsibilities there and the fund. So we have Scott and we have Jay, and I know that both of them hold it. And in fact, if I go back to that little, if I go back to that statement, I'm sure I can find where it is on there. Here it is. Yep.
How many shares does it say? Or
he has 122 shares before the after the reverse split. So he probably had 1,000 or whatever, right?
Sure.
Yep.
Sure.
Now, bear in mind, we have 61 funds, and he owns all of them. So,
yeah.
Oh, well, actually, let me correct that. I believe he has all of the U.S. ones. There would be no reason for him to own the UCITS. So I'm imagining he does not own those.
Good point. When I used to work in financial planning, or no one holds assets in their own name. Lots of people try to hold assets in different names than your personal name. I thought that may have been it too. A lot of people use charitable remainder trust and all kinds of complicated structures to own something, to be a
He does have that. Yeah, I mean, obviously you need to do that for estate planning purposes, but I also believe that some of this was held in the name of his financial firm as well. So Zega was the name of his firm, and that actually is showing up there. But Zega is not a, that is not a, that's not the portfolio manager. So, if you're trying to imagine how the filings tie each other out, there's almost 25,000 shares inside that umbrella as well.
Yeah.
And I'm sure there are others, to your point. And I'm sure he's not going to say, "Oh, why don't you come over to my house and go through the filing cabinet?"
And I wouldn't expect him to. Neither would you, neither would I, neither would anyone I know.
I have absolutely seen some communications, though, going back and forth between compliance, legal, and people on the investment team who are trying to understand why, if we own these things, do the filings not reflect that? When it's clear that, for example, Mike Venuto is publishing his holdings on Blossom. In Jay's case, he holds these shares. He's held them since they first created the fund. So, and this is largely because it is not just that it's important to understand that they own them because of they eat your own cooking. It's also so that you know what's happening. I'll give you an example. We had a situation last year. It was in the fourth quarter where there was a delay in distributions due to a filing error that took place at the custodian bank. And we became aware of it when we started hearing from people. And what's interesting is that we actually reviewed how this was being reflected in customer statements by reviewing Michael Venuto's statements. So we would all get onto a call and say, Venuto would bring up his account and we'd say, okay, what do you see in your account? Because we were hearing back from people who had accounts at different places that they were seeing and hearing different things. And indeed, in his case, it was very strange what we saw. So number one, it showed that the dividend is pending. And then there was a subsequent point where he got it and it was pulled. I think it was pulled back. And then he finally did get it. And then it was dated as of 2 or 3 days earlier. But we had been reviewing it every day. So I know that 2 days earlier it hadn't been showing. And then it showed in his account, oh yeah, you got your distribution. And it was dated 2 days earlier. We're like, wait a minute. We were in the account 2 days ago. We were all looking at it. We didn't see it. Now it's showing as if it had happened back then, which we know it didn't. So it's important that, the participants here have, are invested in these not only so that people are confident that the managers are, putting their own sort of money behind the funds, but also just so that you can have that kind of thing. And that's when it's really helpful when people have different accounts at different institutions, right? So Mike Venuto's accounts are not at Schwab.
Yeah.
In this particular case, the one I just showed you, those are Jay's accounts, or it's one of Jay's accounts.
Yeah.
Then of course there are other institutions, and I already mentioned, where have I traded these things? In Interactive Brokers. So I, by the way, don't own every single fund. We'll just make that clear. I don't, and nor would I, because in my particular case, I'm more interested in Ulti in particular. I'm interested in the target 12s as sort of a backstop.
Yeah.
I think Biggie is sort of like, to me, it's my is home base, if you think about it this way. Allocate to Biggie and then tactically deploy elsewhere. But other people inside the institution might have a different perspective on that.
Well, I always tell people not to get these if you don't need income. You're still a fairly young guy and you work, Jay. I know that Jay has them also to show support for the thing, but it may not be a great use case for you. But here in 20 years, when you aren't working, maybe, or, and when you retire full time, then it might make more sense to allocate to some of these income opportunities. I think a lot of people are expecting growth from these, and that's a problem.
I mean, some of them have experienced growth. Some of them have distributed beyond the income that they've gotten, and if that happens, when that happens, if you make 20% in a fund and you distribute 40%, that means that the net asset value per share is going to be down by that incremental 20%. So people can do a couple of things. You can reinvest. Oh, by the way, that's well worth noting. For people who are interested, because this has come up a couple of times in the past, that goes to the return of capital, right? So if you get a return of capital distribution and you want to reallocate to a given fund or to some other fund, it will increase your basis. We estimate what the return of capital numbers are throughout the year, but now you don't need to estimate, because you can go right to YieldMax ETFs.com, and I'm going to, if there are folks, I'm going to share this because some people may not know. So if you go to the YieldMax website and you do / tax documents. Okay. And these ICI primary ones right here. So if you see right down here, these are sort of the all-encompassing tax information with respect to distributions to calculate what you got for the year. So you can go to the 2025 and then you can pull up the spreadsheet. Now, I apologize in advance because this is going to seem like a lot of information, and it is, because it is the information for every distribution for every fund. But then you can look up all of the respective distributions, and you can see the total distribution. That's going to be the one here in column J, right? And the income portion. So that's going to be that number is going to be either in column N or column Q. Okay. And the ones that, if you're looking for the return of capital, that's going to be the non-ordinary, non-dividend distributions. That's over here. So these amounts of the distributions are the amount that are not an immediately taxable event. This is how much your basis goes down for each of these distributions. And all of these distributions, you can see, it's for every distribution, for every symbol is listed on this one sheet. Now, so obviously what you'd want to do is, if you probably don't own every fund and maybe not have owned every fund for the entirety of the year the way Jay Pestrochelli did. But if you didn't, then you can just, impose a filter and, just go and say, oh, okay, well, I'm only really interested in Biggie, or I'm only really interested in GDXY because I had the minor one for the year. And then I can go like that. And then I can immediately see them. And on the columns, I can see the totals, I can see the income portion, and I can see the return of capital portion, just as simple as that. So that's, I think, maybe something that people will find useful at this point, because it's time to start doing our taxes.
No, that's great. That is useful. And we talk about rock all the time. I have one more question for you, but I know we're going over your time. Do you have time to take one more question?
I'm happy to keep going. Okay. Sure.
All right. That's great. Well, because this is kind of an important question. Let's talk about ULTY. Now, that one's kind of been a lightning rod for controversy. I know you understand that, but I understand it. I think the last time I spoke with you, you had just been added to the investment committee. and
That's
your
correct.
role had picked up there. And also, I know from somebody other than you that I talked to at the company, but that you guys started rebuilding that strategy in the first or second week of November. I mean, that's when I first heard about it.
Yeah. So
yeah.
yeah, I mean, we basically, so we put a sticker on the prospectus the first week of December.
Okay.
So officially, that's kind of the way to, to think about it. But what was going on behind the scenes was happening even before then. So I think that if people say, okay, well, how have things been going? First of all, I would say they were going great. They were going great on a relative basis from when those changes first went into effect up until we had that big swoon in the metals, because we had exposure there, and we still do have exposure there. So I guess it's probably not that surprising. The question people should ask themselves right now is, net of the setbacks that we've seen in precious metals, do you want to start pairing your precious metal exposure right now, or do you want to continue to hold on to it? If we take a look at how gold and silver are relative to their long-term moving averages, I would actually say that we've come back to a reset in that area. Was healthy. It was to be expected. They were extended. We definitely saw that, but I still think people should remain exposed because the thesis behind that trade remains intact. That said, so we'll call it, whatever. That was end of January, but maybe I'll just run this until the end of January so we can sort of see how things looked. And then we're going to compare it to the broad market. So from December 1st until the end of December, Alti's total returns up about 2.8% in round numbers. And over that same period, SPY was up 2, so it outperformed SPY by, about 80 basis points. Qs, and I think it's worth talking about the Qs because one of the things you're going to see is that the faster growing names, and like the NVIDIAs, which we held, and Alphabet, which we held, those are larger constituents of. We had probably closer correlation to the NASDAQ in general than we did, and we outperformed that by about 200 basis points on a total return basis. So from our perspective, we were very, very happy with that performance. Now, since that time, obviously the metals have pulled back. We can take a quick peek at what's in this thing. And I think that's probably worthwhile.
Heck yeah.
So some of the same things that we've talked about remain in the portfolio. You will see, for example, that NVIDIA still in there, largest constituent, just like it is for the Qs, just like it is for SPY, even though it outperformed during that period of time. Alphabet still in there. So one of the other things you'll probably observe is that it's not like the portfolio is really turning over a whole lot or rolling over a whole lot. But, that's one of the things you're going to see. And obviously the gold exposure is in here. Iron, I'm going to highlight this because there are folks who are on the investment committee who get what we call special situations. So even though a name may not necessarily adhere to other aspects of the screening process, what would an example of that be? So in my own security selection screening process, I like to see positive free cash flow.
Okay.
So a good free cash flow yield and good free cash flow yield growth. But the portfolio's IPS specifically outlines a sleeve of special situations. Iron is one of the names that falls into this. Some of the folks on the investment committee feel fairly strongly about this one. Now, it didn't do so great coming out of earnings, but what's interesting is that, remember that Alti is collaring these positions. So it fell, but we actually had protection, and it went right through our long put strike. So we weren't actually taking any of that punishment to the downside. We also, Iron and Roblox, which is also in the fund, reported on the same day. And I think Iron fell 9. I want to say it was 9% at the time I was looking at it after hours. And then Roblox was up 15% on or around the same time. So, benefits of diversification showing their worth. The collars were showing their worth. And, I think, personally, I don't really take issue, and I doubt too many others do, with pretty much anything in here at these levels. And I think just to take one point a little bit further, why don't we just take a quick peek at silver? Because obviously with the silver miners, we have some exposure. And look where it came. Basically, it came right back to the 50-day moving average. So obviously it had gotten a little bit extended right before they actually, benefit of hindsight. You wish you'd sold a lot more of it.
Oh,
but Mike Venuto and Jay and Scott, they actually reduced the metals exposure. Sometimes it's better to be lucky than good.
Yeah.
But basically what happened was it had just gone so far so fast that it had effectively become outsized in the portfolio, and they adjusted it. But you can see by their holdings that this is not that they think the underpinning story is totally broken. Otherwise, they would have sold it all. It's just that it has now come back, and that is a meaningful pullback. So I think for Alti to sort of held in there as well as it did since the revisions to the IPS took place that first week of December, and how it's performed, I think, very favorably relative to the broad market indices, particularly net of the metals exposure. I think it's in a good spot now. So I've been very happy with how that has been performing since then.
Can you talk a little bit about conditional correlation? Because I understand that that's kind of a big key to the way you guys have rebuilt this, but I don't really fully understand it. Could you explain it?
Yeah, so it's interesting. And I actually kept some of the examples that I like to provide for people loaded up. So that's the perspective. But this is Alti as of the highs, which it saw in October. So I'm just going to put this to October of 2025, and I'm going to go back, we'll call it 5 weeks or so. Okay. So what are we looking at here? So it just looks like the movie The Matrix, just a series of numbers and gibberish. That's because this is a matrix. This is what's called a correlation matrix. Basically, what it's doing is it's calculating the pairwise correlation of every single constituent of the portfolio. So we've got about 20 stocks over here. You can see them over here on the left.
Yep.
And if you notice, the same stocks are also all of the columns going from left to right. So this is comparing, obviously, the pairwise correlation between the stock with itself is always going to be 1. The stock is perfectly correlated with itself, which is the reason why all of these going down on a diagonal like this are all 1s. Now, notice the important thing here is don't pay attention to the numbers, pay attention to the colors.
Yeah.
Whenever you see a color is white, think white hot or perfect correlation. So you're going to see that the numbers are white when the pairwise correlations are high. So strategy and coin, that's not surprising, had a relatively high pairwise correlation. So this was for the 5 weeks leading up to Alti's all-time highs in early October. Take a look, just take a picture of that in your mind. You see a lot of dark brown, you see a little bit of light brown, and interspersed with some white.
Yep.
Now let's take a look at what happened to the correlations between all of those respective stocks in the 5 weeks since it hit that high.
Okay.
See if you notice a difference.
Yep. I think I got it.
There you go. So basically, the correlation between all of these securities shot up. Now, in some cases, correlation makes sense. I pointed to one. Strategy and Coinbase are both highly tied to the crypto trade. So it's not surprising that the correlations would be high, and indeed they were. As it turns out, something like Robinhood, you'll notice that Robinhood also was very correlated with the crypto trade. But there are names in here where it wouldn't necessarily be that intuitive that the correlations would be so high. So, for example, Hims, that's actually the company Hims and Hers. They are a generic pharmaceutical company.
Yeah.
They make, generic versions of hair growth, but also they were doing the GLP-1. So when the FDA determines that a needed drug is in short supply, they can grant permission to generic pharmaceutical companies to compound it themselves in the public interest. Now, as it happens, they've recently kind of lost this. So they've established that it's not going to be necessary. So that's one of the things that was important. But the thing to think about is that what all of these companies had in common was that they were relatively high beta, more volatile stocks, higher beta stocks. And they were what we might call a crowded trade amongst those that were really, sort of chasing beta. And so what ended up happening was when cryptocurrency rolled over, a lot of these other companies sort of got taken out with it. The easiest way to describe this, and the expression that people have almost certainly heard, is risk on, risk off. High beta stocks are a risk on trade. And when you move to a risk off environment, whatever it is that caused that risk off environment, it's not uncommon for the correlation in those stocks to suddenly rise. So what was previously a well-diversified portfolio turns out not to be in a risk-off environment. And if you look at the Alti strategy now, what you're going to see is that there is still some of this, because Alti, as its name implies, is going to be looking for stocks that have good implied volatilities to sell. It is also true that some of the stocks that are in this are somewhat tied to a risk on. We still own strategy stock in here, for example. And we've got the miners and some metal. That's going to be slightly higher beta. But what you're also going to observe is that it's not all of that, right? So Amazon, for example, is not a particularly high beta name. Alphabet is not a particularly high beta name. And in fact, these are companies that generate massive amounts of free cash flow. If anything, they might be thought of as sort of safe havens, best of breed in their respective areas. And something like Southern Copper, and also metals are not necessarily a correlated trade. They happen to be for a period of time. So this is why I made the point earlier that when I say non-correlated, that the way that the investment team decided they wanted to do this was they wanted to have at least 30% of the portfolio in sort of non-correlated names. Non-correlated doesn't mean anti-correlated. That does not mean that if the stocks that are in there go down, these will go up. But it does mean that in general, they're not closely correlated. And we know that correlation can move around, but what we were trying to do was reduce the conditional correlation, specifically the conditional correlation in the event of market declines. And I think we've done that.
Absolutely. No, absolutely. That ULTY is it still is $1 billion fund. I mean, it was a $3 billion fund. My theory on it was that it really probably should have never got that big. I think that maybe people, got excited about it this summer, and it's easy to do. It was doing great this summer, and it turned into a big fund. I also think there's a misconception that you guys are compensated, that you guys are incentivized to charge the highest fee you can, and you don't care what happens to the AUM. And I try to explain to people that the way a money manager makes money is by growing their AUM. And that's what right. You guys are. I mean, so you can't grow AUM. One thing, you have to pick good stocks where the stocks grow, and that makes the AUM grow, but you also have to make customers want it. So,
well, that's right.
Yeah.
So it's a very good example that you provide, because if you think about something like Misty, right? Okay. So Misty at its core is long strategy stock. Now, after strategy hit its peak in mid-July of last year, a lot of people sold the stock. A lot of people may have sold Misty because they no longer liked the stock. But as a fund manager, one of the things that impacts us is that as the stock goes down, the value of the underpinning assets fall if we do nothing. And that strategy, by the way, is to be long strategy. So irrespective of how we feel about strategy, those single stock options income funds are going to be either long, as is the case for most of them, or short, as is the case for just a relative handful, the underlying asset or a proxy for it, and then sell premium against it. And that's predetermined, right? So the fund managers make no determination about that. Misty fell, it didn't do well last year because strategy didn't do well. But what I like to show people is that it did outperform strategy. Now, you could say, that's small consolation, and I would 100% agree. But the difference is profound. If you had bought Misty on the last day of 2024 and you just simply took the distributions out in cash, you ended up losing a little less than 10% for the year. Now the share price was down huge. It was down, 77.5%. But you would have taken almost 70% of your initial investment out in distributions. Now, if you had put it into MSTR on the same days, you'd have been down 60%. And that's not a small difference. That's a 50% difference. So, a big portion of the performance of Misty is going to be Mr. because it owns it, or it actually owns a proxy for it. And if the stock goes down 60%, it's tough to make up for that. And that's not up to the fund manager doesn't get to say, oh, well, actually, I want to be short strategy here. No, that's not what the fund is. The fund is options income on strategy stock long. If you wanted the bearish one, then that was going to be Winter. And Winter, of course, that was a different situation, as we can see here. So Winter, of course, was up on the year.
So the other day when MicroStrategy bounced 25%, Mystic was also up 25%. That's pretty good.
Well, you know why? It's because these are options income. A lot of people refer to them as covered call ETFs, but they are actually option income ETFs. And we can actually see that when we look in what is a covered call? Covered call, you're long the underlying or a proxy for it, and you sell calls against it. That's easy enough. But actually, when we take a look at Misty, what you're going to see is that it is indeed short some call options, but it is also long a lot of call options. And so really it's short call spreads. And the objective here is that in those situations where the underlying stock really takes off, we want to have some participation because, folks will know this. Anyone who's watched stocks behave is that they don't move in straight lines. They don't go diagonally up. They don't go dead sideways, and they don't go diagonally down. They chop around. You can have a handful of days that account for a disproportionate amount of the returns of a security over some longer period of time. And so the disadvantage, if you're simply doing covered calls, is that while you're collecting income, you miss out on participation on those single really big days. By selling call spreads, we reduce the amount of premium and income that we're collecting, over time, but we get way more participation when the underlying suddenly shoots up, for whether it's a reason that's obvious or not. At the end of last year, there were weeks when AMD was up 15%, and there was a week when NVIDIA was up 15%. And in both of those cases, we were able to capture about 80% of that upside move. In the case of Misty, we got a little bit better returns, at least on that one day when it really bounced. And it's because of the call spreads rather than just simply selling covered calls. Because if we were just selling covered calls instead of call spreads, the income that you'd be getting would be slightly higher, but then you wouldn't have an opportunity to participate on those big rebounds when they took place.
It might have been up 5% with the old build of Misty. I look at this every day. It is how much the fund's up and how much the underline's up. Yeah, with the old build before Jay put in the call spreads, might have been up 4 or 5%, and where the MicroStrategies is up 25%. Those call spreads have been huge, and I think a lot of people don't realize that really differentiates YieldMax. I don't think anyone else is doing that. But anyway, I really like that idea. And we've also run out of time today, Mike, but I appreciate you being here.
Well, I'm glad it took place on President's Day because the markets are closed. So under normal circumstances, my day is pretty rigorously segmented. Other people set my schedule. But, it was interesting because my wife asked me, she said, oh, you have, video interviews today. And I said, yeah. She says, isn't it the day off? I said, this is the best time for it because I'm not getting pulled in a million different directions. I can have a conversation, and however long it takes, it takes.
Well, we really appreciate it. Hey, so hang around here for a second, Mike. I want to talk to you, but I'm going to cut the live stream loose. Guys, I appreciate all the comments. We didn't really ask any questions from the live stream audience, but I saw what they're talking about, and I feel that that we got everything covered. But anyway, if you put a question up here and I didn't get to it, I'm sincerely sorry. Anyway, thank you guys so much for being here. Remember, as always, this is not financial advice. Please consult a licensed financial planner, and I will see you guys soon.